I don't do many requests. There are just too many of them coming in for that to be practical. But a subscriber asked me to cover a topic that I think could be very useful for most of you. What it boiled down to was this. Let's say that you are presented with the siren song of free money, in this case a 401k. You can put a certain percentage of your income into the 401k and defer some of your income tax until later. And what's better is that your employer will match up to a certain amount of what you put in. Is this a good deal, or is it a bad deal for you? Let's explore the question. You'll have to do your own math to answer the question for yourself, but I can give you some things to consider. Before we delve in, let me make it perfectly clear that I view all financial assets as speculative. They can certainly serve a purpose, as I will show you, but they are not the panacea many financial experts would have you believe. But I will show you how you can use them so that Uncle Sam and your company pay for some volatility protection for your precious metals portfolio. Now, the first thing that you'll need to understand is our current progressive tax system. We'll assume that you are married and filing jointly. If you're single, then you'll need to look up the U.S. tax brackets for someone who is single. Here we can see that for someone married and filing jointly, the federal income tax rate is 10% for all of your adjusted gross income up to $18,650. Adjusted gross income is different than your actual income, and we'll discuss that in a moment. The tax rate on all adjusted gross income between $18,650 and $75,900 is 15%. These are pretty modest rates of tax, which will certainly be of benefit to a person who does not earn much income. They will also benefit the gold and silver owner, by the way, and to find out why, please watch my video, The Mythical 28% Collectibles Tax. Now, above $75,900, the tax rate goes up quickly. For an adjusted gross income between $75,900 and $153,100, the tax rate is 25%. It then goes to 28% and 33%. Let's now discuss adjusted gross income, or AGI. The government does not tax your full income. They allow you to take deductions and reduce what you report as taxable income. It is these deductions that keep the tax attorneys and accountants employed, mainly because they are so complicated. I'm not going to discuss the complex world of deductions here. Personally, I think elaborate deductions were invented to help very high income earners reduce their tax load and to keep average people in debt. For example, mortgage interest is deductible, but in order to benefit from the deduction, you have to maintain a large debt that is secured by your house. And for every dollar that you save this way in taxes, you are probably paying 3 times or more of that to the bank. Now, how does that make sense? But the government gives you a standard deduction as a freebie. Everyone gets this. It is only when all other deductions exceed this amount that it makes sense to itemize all of your deductions and file an elaborate tax return. The standard deduction for a person who is married and filing jointly is $12,700. This gets taken right off of your income in computing your AGI. If you are over 65, you get to take an additional $1,250 off. If your spouse is over 65, you get to take an additional $1,250 off for him or her. In addition, you will also be given exemptions. Exemptions are credits which also reduce your AGI. If you are married and filing jointly, you get to take one exemption for yourself and one for your spouse. You also get to take one for each one of your dependent children. Now let's do an example and see how this might matter both before and after retirement. This calculation is entirely hypothetical. It does not apply to my current situation, nor do I think that it will necessarily apply to yours. But the way that you do the math will be the same, and so all you'll need to do is understand the method and then change the numbers for yourself. In this example, we'll assume that you are married with 3 kids. Between you and your spouse, you earn a combined salary of $120,000. You paid off your home mortgage, and so you will use the standard deduction of $12,700. You, plus your spouse, plus your 3 dependent children, will give you 5 exemptions, worth a total of $20,250. When we deduct the standard deduction plus exemptions from the combined salary of $120,000, we are left with an adjusted gross income of $87,050, and this is what gets taxed. Going down the table, we can see how much tax gets paid in each bracket. $18,650 is taxed at the 10% level. There is $57,250 in the next bracket, which is taxed at 15%. Then we have $11,150, which is taxed at 25%. When we multiply it all out to calculate the federal tax due, it will work out to $13,240. So the effective tax rate is not really 25%, it is 11%, or $13,240 of tax on $120,000 earned. The 25% is what's called the marginal rate. Every dollar that you earn over and above your current salary is taxed at 25%. What's more, you'll be paying state tax on all of that money as well. If we add your state tax rate into the equation, here, which is assumed to be 6.65%, we find that your total marginal tax rate is close to 32%. In other words, the government takes about 1/3 of every marginal dollar that you earn. Notice I highlighted a couple of numbers in blue. We have $11,150 worth of income being taxed at the 25% level. And this is a pretty high tax rate. It would be nice to be able to reduce it if possible. If we could get our realized income down to $108,850, then we could avoid paying the high tax on this incremental money, at least for right now. And this is where the traditional 401k and IRA plans come into play. If you were to deposit $11,150 or 9.3% of your total salary into your 401k, it would get you down to the 15% marginal federal tax bracket. And I'm not saying that this is what you should do, I'm just showing you how the system works. To see how deferring this income might be to your benefit, let's assume that in retirement you think that you will only need $70,000 worth of actual income to live a comfortable life. Now again, this is just a contrived study. Many people live very happy lives on much less. And at the same time, some people have trouble making ends meet on 3 or 4 times this amount. But in this case, you might meet this need for $70,000 in a couple of different ways. You might sell some assets such as gold or silver, as I highlighted in my video, the mythical 28% collectibles tax. Or maybe you'll take some withdrawals from your 401k. Or maybe a combination of the two. Now, being retired, you're down to only 2 exemptions, yourself and your spouse, leaving you with $8,100 worth of exemptions. But if you and your spouse are over 65, your standard deduction goes up to $15,200. And so while your total realized income is $70,000, your taxable income is only $46,700. Of this, $18,650 will be taxed at 10%, and the remaining $28,050 will be taxed at 15%. This brings the effective tax rate down to 8.68%. Now, maybe you were even more clever, and you moved to a state with no income tax, such as Florida, and so your effective total tax rate is 8.68%. When you compare this against the marginal rate of 32% that you're being taxed right now, you can see how this could be of quite a bit of benefit. The tax deferral really starts to look quite attractive, especially if you don't have to wait too long to access the funds without a penalty. Now, notice too that you could have realized an income up to $96,700 per year in retirement before moving up to the 25% federal tax bracket. So let's take a look at what this hypothetical tax deferral would mean in terms of rate of return. We said that with the given set of assumptions, you can defer $11,150 worth of income by putting it into the traditional 401k. Now, assume for now that there's no employer match. We'll consider the case of the employer match in a moment. If you take the $11,150 as salary right now, you will pay a 32% tax on it between federal and state taxes. This will leave $7,582 that can either be spent or invested now. If, on the other hand, you defer the income and withdraw it later, you will be taxed at a much more favorable rate of 8.68% effective. Now, let's consider only the tax benefits and assume that whatever you put your money into inside the 401k only keeps pace with price inflation. In N years, you will have $11,150 in current dollars pre-tax. You withdraw it and pay the 8.68% tax, leaving you with $10,183 in after-tax cash that can be either spent or invested. Your after-tax spendable cash is 34.3% greater than it would have been otherwise, and this is without even considering the generation of any kind of investment return. Now, an interesting question that you should ask yourself at this point is this. If you decided to take the $7,582 of after-tax money now and invested it, what kind of an investment return would you need to make so that at the end of N years you would be left with at least $10,183 of after-tax purchasing power? In this chart below, I illustrate the benefit of the tax deferral over N years. If you only have 1 year to go before you are eligible to start receiving the more favorable tax treatment, then you would need to generate a real rate of return on your investment of 38%. Wait, you say. I thought you said that the increase in after-tax funds would be 34.3%. Why would I need a gain of 38%? Well, that's a good question. Don't forget that you'll still need to pay the 8.68% tax rate on any gain that you generate. This assumes, of course, that you don't generate any taxable events in the meantime, which would be taxed at your currently high marginal rate of 32%. Now, do you think that you can guarantee yourself a 38% real inflation-adjusted return outside of the 401k? I have my doubts. But this is only if you have 1 year left to go. What if you have 5 years? Out at year 5, you'd need a real rate of return of 6.7%. Doable? Yes. Likely? Probably not. Guaranteed? No. Now, if you have 10 years left to go, the benefit of the tax deferral is a real rate of return of 3.3% per year. Still pretty high and worth considering taking advantage of. But you get the point, I'm sure. But we still haven't gotten to the subject of the employer match. How does the picture change if you get a, say, 100% match on a certain amount of these funds between you and your spouse? Say that you get a 100% match on the total of $11,150 deferred because you're going to be taking advantage of your 401k plan and your spouse's. Here, the difference is quite interesting. The same $7,582 of current after-tax income is deferred, but this time, the pre-tax contribution was doubled by the employer match. Taking the money out N years from now and paying the effective 8.68% effective tax on it leaves $20,365 in after-tax spendable money. Again, I'm assuming here that these are current dollars that have been adjusted for price inflation. In other words, the investment that you chose just barely keeps up with price increases. Now let's ask the same question as before. What kind of an after-tax return would be needed over a given time frame to give the same effects as the combined tax deferral and company match? If you only have 1 year to go before taking the funds out of your 401k, then the rate of return that you'd need to beat is 185%. Personally, I think that that's probably too much to expect, and so not taking advantage of the 401k under these circumstances is probably not a very smart thing to do. If you have 5 years to go, then the real rate of return equivalent that you'd need to beat is 24% per year. It's an easier hurdle to beat, but remember, it would have to be maintained over 5 years. Even if you might think that that sounds easy, it's not, and it certainly can't be guaranteed. But even if you have 10 years to go, the benefit of tax deferral plus the company match is worth an unsheltered real 11% per year to enjoy the same after-tax purchasing power 10 years from now. And even out at the 30-year mark, the tax deferral plus company match is the equivalent of a real 3.7% rate of return. So I think you can see where I'm going with all this. Now, you all know that I'm not a big fan of the 401k, mostly because of the nature of the investment choices provided. They are all financial assets. Personally, I don't like them very much. I'm much more comfortable with gold and silver, but at the same time, I'm a pragmatist. Do I think that there's risk in investing in a 401k? Absolutely. But assuming that you're saving significantly more than the few percent that you're going to be putting in your 401k, the speculative investment in the 401k can be worth it, if approached with both eyes open, because it can increase your odds of a successful retirement, especially if you don't have too many years to go. Again, I'd like to stress that I view the 401k as a speculative vehicle. It is not the panacea that many financial advisors make it out to be. But there is another benefit that I haven't touched on yet, and that is the benefit of low-cost hedging of your gold and silver portfolio. Let's discuss that for a moment, and I'm sure that you're going to find this information useful. In my last video, I discussed the volatility of precious metals in terms of dollars, and how to reduce the emotional pain of a long-term or deep slide in precious metals prices. I focused at the time on keeping track of the average cost basis for a program of monthly accumulation. Maintaining discipline is certainly a good start, but we can take it further, and take advantage of Uncle Sam and your company to help even things out even more. This is a chart which represents every 10-year period going all the way back to when Nixon closed the gold window. Each dot on the chart represents a 10-year real price inflation adjusted rate of return annualized over that 10-year period for gold, for the S&P, and for 10-year bonds. I use 10-year periods because it removes much of the noise. Anything much shorter than 10 years really doesn't lend itself to reliable analysis. Now, notice that there is a fairly well-defined linear relationship between gold returns and stock and bond returns. When gold does poorly, stocks and bonds tend to do well. When gold does well, stocks and bonds do poorly. This really should come as no surprise. What we're dealing with here are human emotions. The lure of financial profits from stocks and bonds tends to take people's attention off of gold and vice versa. When everyone thinks that financial assets are a horrible place to be, they tend to flock towards gold. It's actually quite a tight relationship. Notice, for example, that there wasn't a single 10-year period in which both stocks and gold provided a negative 10-year annualized return. Notice that bonds and stocks are positively correlated. When one of them does well, the other one tends to do well. And this should not be a big surprise. A favorable business climate inspires consumers to borrow and spend. It also inspires companies to borrow for projects. Excuse me. And this puts upward pressure on interest rates and allows lenders to enjoy higher rates of return on their funds. The consequence of this positive correlation is that bonds are not quite the hedge against poor stock performance that financial experts would have you believe. But focus mainly on the very negative correlation between stocks and gold. For every additional 1% per year gold performance, stocks tend to do worse by about 0.5% per year. For every 1% worse gold performs, stocks tend to perform better by about 0.5% per year. One might be tempted to say that for this reason, gold can be considered as a hedge on a stock portfolio. Of course, the other way that a person could look at it is that stocks can be used to hedge a gold portfolio. And I'll say that again to emphasize the point. A small position in stocks can help a person hedge against the occasional drop in gold price, simply because the two investments tend to move in opposite directions. Though, before you object too vehemently against putting your hard-earned money into stocks as a hedge, let me remind you of something. If you were buying stocks in a 401k program as a hedge, then most of the stock position was actually paid for not from your own money. Remember, it's not the same as buying an investment with money that has already been taxed. If you go back a few slides, you will notice that by foregoing $7,582 of after-tax spending money, you can actually buy a $11,150 stock position in your 401k. And if the company matches your funds, then that same $7,582 of foregone after-tax spending money will allow you to buy a $20,365 stock position. For every dollar of after-tax money that you defer in your 401k account, you can buy $2.7 worth of stock. Now, did I get your attention? Let's do a little math. Let's suppose that you take a look at this chart and say to yourself, it really would be nice to hedge my gold with an equal amount of stock. What would it cost to do this? Now, assume that you buy $1,000 worth of gold. You do this with after-tax money. and you'd like to control $1,000 worth of stock as a hedge against adverse price movements in gold. What will this cost you in after-tax money? Well, divide $1,000 by the 2.7 factor and you get $370. That's right. By foregoing $370 of after-tax money, you can hedge $1,000 worth of gold with an equal amount of stock. The other $630 of the stock investment comes to you compliments of Uncle Sam and the company that you work for who is providing the match. Most of the risk that you are taking in buying the stock in this fashion is borne by others. Now how's that for a little mathematical magic? Now this is all very academic. Let's see how a 50-50 portfolio of stocks and gold would have performed over the past nearly 50 years and compare it to other investment approaches. Here is a chart showing on a logarithmic scale the real increase in purchasing power of $100 of today's dollars invested back in 1968. The black trace represents an investment in the S&P 500 stock index alone with all dividends reinvested. I'm neglecting taxes for now to make the analysis simple. Notice that in the 1970s, stocks performed abysmally. Then in 1982 to 2000, stocks performed really well. In the period from 2000 to 2011, stocks didn't perform very well at all. Now, although it was a very bumpy ride, someone holding just stocks saw their real wealth increase by a little bit more than a factor of 14 over this whole time frame. Gold is shown in yellow, and it's had a very bumpy ride in dollar terms. It did really well in the 1970s, especially when compared against stocks. It did poorly from about 1980 through 2000, again in contrast to stocks, which performed really well. Then from 2001 to 2011, gold did very well again. Overall, it was a very bumpy ride when measured in dollars, but in the end, the person who held gold all the way through increased their wealth by a factor of 5. Now, bonds are shown here for completeness, mainly because they are recommended as the preferred hedge against stocks. Notice that they had their good periods and their bad periods. Their volatility as measured in dollars was much lower than stocks or gold, which is probably why so many financial experts recommend that bonds make up the stable portion of your portfolio. In the end, the bond-only holder, assuming taxes are neglected, increased his or her wealth by a factor of 4.5. Now, this is actually a worse showing than gold by itself, which is often stated to be a bad investment simply because gold doesn't pay interest. Now, this should tell you something, and I've covered the reason why in past videos. Now let's focus our attention on a 50-50 mix of stocks and gold and compare it against a 50-50 mix of stocks and bonds. The gold stock mix is shown in blue, and the bond stock mix is shown in red. One thing to pay special attention to is that the blue trace is almost linear on a logarithmic scale. This means that its performance on a real rate of growth basis was much more stable and predictable than any other asset class or mix alone, and more even so than a mix of stocks and bonds. Notice the mix of stocks and bonds did poorly in the 1970s. By contrast, the mix of gold and stocks did just fine. And I'm sure that Harry Brown, if he were alive today, would be smiling. Ultimately, the owner of the 50-50 gold and stock mix increased their real wealth by a factor of almost 12. Almost as much as the owner of the 100% stock portfolio, but with much less of a bumpy ride. But this all doesn't answer the question of what we might expect going forward. Is the past prologue? Maybe. I personally don't think so. And so I've constructed the next chart to just illustrate what I think is going to happen. Here what I've done is I've taken the variances of all individual asset returns and also the covariances between the assets to estimate how volatile 10-year annualized rates of return are likely to be going forward based upon the past 50 years. I adjusted expected returns based upon valuations. Currently, I'm estimating that gold will appreciate in value by at least 8% per year on a real basis. And this is based upon various assumptions that I've spelled out in many of my past videos, and so I'm not going to go into more detail here. Suffice it to say that gold right now is valued comparably to how it was valued in the early 1970s and also in the early 2000s. Now, this doesn't mean that its dollar price won't drop, only that it's more likely to perform well than to perform poorly going forward. Gold is shown on this chart as the yellow square. Bonds are likely not to perform very well going forward. The current 20-year Treasury yield is 2.78%, and the 20-year TIPS yield is 0.82%. This means that bond buyers are expecting an annualized inflation rate of 1.96% and a real return on bonds of about 0.8%. Bonds alone are shown on this chart as a blue square. Now, stocks probably won't perform too much better than bonds. The current dividend yield is 2%. For the past 50 years, dividends have grown at a price inflation adjusted rate of 1.6%. Now, most people would say that this would indicate that the return on stocks should be 3.6% per year. I personally think that this is a little on the optimistic side, because over the same 50-year period, the average dividend yield was 3%, and we should admit to the possibility of prices declining over the next couple of decades to bring them more in line with historic dividend yields. If we admit that this is a possibility, then real returns on stocks will likely be closer to 1.6% per year. So let's assume that we'll have a real return on stocks somewhere in the neighborhood of 1.6 to 3.6% per year on a real inflation-adjusted basis. It's certainly much worse than what's predicted for gold, or at least for what I'm predicting for gold. So that said, if my prediction for gold turns out to be true, why bother with stocks at all? Well, it has to do with price volatility and admitting to potential for the error in expected returns. We don't know with much certainty what the returns for each individual asset class will be going forward. We have a general idea, but we can't say for sure. What we do know with a fair degree of certainty is that stocks and gold are likely to move in opposite directions in the future, as they have for the past 50 years. They sure did so from the period from 2011 to the present, haven't they? And so, if we want our standard deviation of expected return, in other words our volatility, to be lower, and move us to the left on this chart, we should start with gold, being that it has the highest rate of return, and then add some stocks as a hedge. Every orange dot is a 5% increment in gold in a stock portfolio. So one dot to the left of the yellow square is a 95% gold and 5% stock portfolio. 2 dots to the left is a 90% 10% position, and so on. The minimum variability can be achieved with a mix of 40% gold and 60% stocks. But personally, I don't like this mix. I'm wary of financial assets right now, and so if I buy them, it's going to be as a hedge only. Going as far as a 50-50 mix of stocks and bonds in your or stocks and gold in your portfolio will certainly go a long way towards hedging. And if you do so with a 401k with matching funds to cover the cost of your stocks, then you'll be sharing the cost with your company and the US government. In fact, your company and the US government will bear most of the cost of this hedge. Now, I'm personally more comfortable with a more heavy gold portfolio. Notice on this chart that a 25% stock plus 75% gold portfolio should have about the same volatility as a 100% stock portfolio, but with a much higher return. I kind of like this result myself. Plus, with the lion's share of the hedge being paid for by others, it seems like a pretty cheap way to get some volatility reduction. A 25% position in stock would mean that for every $1,000 that you have in gold, you want to have about $350 in stock. If your tax situation is similar to the couple that I illustrated in this video, then the volatility insurance will only cost $130 after tax. Doing so will smooth out the ride by almost 50%. Now, frankly, that doesn't seem like too much to pay to smooth out the bumps by about 50%. Now, hopefully this video helped with a very confusing topic. I don't personally like the 401k, for the majority of my wealth anyway, but I certainly don't mind using its structure to my benefit. Having Uncle Sam and your company buy your insurance for you should seem pretty attractive to you too.